Schönen guten Tag hier zum Studio Talk direkt vom 33. Private Banking Kongress im Cruise Center Altona. Herrlich gelegen zwischen Fischmarkt und dem Elbstrand Övelgönne. Neben mir stehen John Connor und Kirk Whitney von Crossing Bridge, einem 2016 in New York gegründeten Investor, der auf hochverzinsliche Investmentgrade und opportunistische Unternehmensanleihen mit kurzen Restlaufzeiten spezialisiert ist. Mr. Connor, Mr. Whitney.
Thanks for having us.
Nice
Thanks for having us.
that you made it to sunny Hamburg today. It's very sunny.
It's a beautiful day outside. It's a little cold the past couple of days, but today is beautiful outside.
Today it's wonderful, and
Yeah.
I think it's your premiere at the Private Banking Congress.
Yeah, no, it's been great to have it. This morning was great so far. We've had some great meetings, and it's been a really nice welcome to Germany.
I already mentioned in the introduction that Crossing Bridge is specialized in high-yield investment grade and opportunistic corporate bonds with short residual maturities. How has the market changed over the years?
Yeah, Kirk.
I think the important thing about the market is not only from 2016, from when Crossing Bridge started, but our investment team has well over 20 years of experience, especially on the senior investment team. And there's been a lot of interest rate fluctuations in different credit cycles, but throughout, what makes it different now, I think, is credit spreads are extremely tight, and you still have the longest term of a inverted yield curve in the U.S. Since the 1970s. So for us, we really think it's an opportunity to look at your fixed income investment different.
And why is the focus on bonds with short residual maturities?
So I think when you look at how we approach the investing world, we are focused on bottom-up opportunistic corporate credit, right? Both in investment grade and high yield. When you're doing that, you could take a couple different risks. You take credit risk, you could take duration risk. We don't look at duration as a return driver of your portfolios. We look at duration as a risk in your portfolios, especially in an environment right now where we are at a very uncertain time in the environment. We don't know if rates are going to go up. I'm talking more in the belly to the long end of the curve, because right now we're in a very important day where the Fed is going to make one of the first cuts they have in a while. By how much? 25 basis points, 50 basis points, 75 basis points. We don't know. We also don't know, is the belly of the curve going to stay flat, go up, go down? Is the long end going to go up, stay flat, go down? We don't know. So when we're looking at managing client portfolios, duration to us is just an additional risk that we look to mitigate and really focus on the short on short maturities in our portfolios.
I think that we'd like to add to that from the bottom-up investment approach. We focus on credit selection. We're credit investors. And what's really important for us in our investment process is to look at the business model of the underlying companies. For us, as we stated, we focus on that credit risk. We don't want to throw on that overlay of duration risk, right? And if we do our job correctly as credit underwriters and we're able to diversify that portfolio, we think in any environment we're able to find specific opportunities in different areas that can really help keep our fixed income strategy as kind of a ballast of your portfolio.
And the reason we really like having a bottom-up approach is these are things that we feel like we can analyze, right? We believe we can analyze a company's cash flow. Are they going to pay us back, right? In fixed income, it's nothing more than you're lending money to a company. Are they going to pay you back? And those are things we believe we can analyze. When you start talking about duration and some more of the macro concepts, those are things that are really uncertain and things that we don't feel like we can analyze, and it's more of a bet in which direction things are going to go. And as Kirk mentioned, in fixed income, we believe that fixed income, especially after we saw what we saw in 2022, when fixed income across the board got hurt pretty badly, we believe our goal is to be the ballast of the portfolio and not make macro bets, but really focus on things we can analyze from the bottom-up perspective.
Okay, I think a bit you gave an answer, but high yield or investment grade, in which areas do you see which growth and investment opportunities? For example, what is your view on bonds and loans with maturities of 1 or 2 years?
Yeah, so we really think the short end of the curve right now is the place to be. Because of our view on what's going to happen within interest rate environments, we think that most likely over the next year or two, you're going to have the curve go back to an upward sloping curve. So we think that's going to be tailwind for the short end. And our ability to invest across investment grade and high yield really separates us from just a long-only high yield manager. Right now, we've really gone up in credit quality, so you actually see a higher percentage of our investment in investment grade. But that shorter end of the curve for us, you have a lot more look through from a credit perspective on what a company's going to do in the short term. And again, as John said previously, we're just there to make sure that you get paid back at the end of the day. We're not trying to take outsized risks. And if it's a good business model that's going to pay you back at that day of reckoning, which is your maturity, then we like it as an investment as long as it has the underlying credit characteristics that we think make sense.
And regardless of the economic opportunity or the economic environment, if a company is a good company, as Kirk mentioned, well, really, you have to you're doing your analysis whether or not, again, rates are going up, rates are going down, things are going sideways. We're really doing our analysis to really, again, make sure, is that company going to pay us back or not? The other area of growth that we're really seeing is in the Nordic high yield market. Nordic high yield market in the US is kind of an esoteric term, but a lot of the investors that we've been speaking with here in Germany have investments in the Nordics because I think you guys are much closer in proximity and have a better understanding of the Nordic markets. Currently, we have not seen any dedicated Nordic bond funds in the US. Why do we believe that's a growth opportunity? Well, the Nordic markets offer we believe, a much better credit profile for much more spread than what you get in the US. And also there's covenants, which have been lacking pretty much in the US credit market. So we're seeing the Nordic markets and also the Nordic markets are the second largest high yield market in the world. And it's about 6 to 8% in size of the US high yield market, but it's also growing at 30% a year, right? So now you're having a market that's growing, and Nordic high yield market today does not mean Nordic companies. It does mean some Nordic companies. I mean, it's predominantly Nordic companies, about 60%, but about 40% of the Nordic high yield market are companies from Germany, companies from the US, companies that are outside of the Nordics going there because of the platform that the Nordics are offering today. So again, better credit quality for better yield with, we think, better protections for investors as well. So we think that's a great opportunity today, and it's only going to continue to grow.
Okay, so good, 3 good reasons. And what type of debt instruments do you prefer and why?
Yeah, so the thing about our strategy is that we have the ability to go to a couple different places with what we do. So we're not benchmark driven, right? So we don't have to be a certain percentage in any specific sector. So we can do floating rate debt. We can do foreign issuers. As John stated, we like the Nordics as an opportunity right now. We can go into CMBS securities in the US. We like SASB, which are not central business district, industrial properties. Again, a collection, a single borrower with a collection of properties where you can, again, we can get a look through to what those cash flows are, because at the end of the day, we need a catalyst for what's going to be paid down as far as debt. So CMBS securities, ABS securities, we have the ability, again, to tilt to investment grade, especially in this environment. We're almost 50% investment grade because spreads are so tight, right? And we think that, again, we like to trade up in credit quality. We like security, right? So if securitized assets, first lien assets, and that's why, again, the Nordic market itself is just a piece of the pie. And again, foreign issuers are now 30%. But we also like floating rate debt. Often you find that in the foreign markets as opposed to the US. Those are a couple things that we're really bullish about in this market.
Yeah, I mean, if you look at credit spreads today, investment grade credit spreads are at historic tights. Double B credit spreads, historic tights. Single B credit spreads, historic tights. Triple C, not historic tights, but to us, if you look at triple Cs are somewhere around long-term average of where they are in spread. But that's kind of a warning to us, or a red flag, because people are saying, okay, well, there's yield there, but if you are a short maturity and you're still a triple C and you haven't refied out your debt, there's probably a reason, right? Not saying that there aren't opportunities there, but our core focus is, again, we rather look for more downside risk management rather than trying to chase this additional yield.
Yeah, protection of capital is paramount in our strategy.
And also not following a benchmark, as Kirk had mentioned. I think that's one of the biggest things. So if you look at where benchmark investment grade spreads are, as I mentioned, double B, single B, you kind of don't want to be there when things are so tight and priced to perfection. We're close to being priced to perfection. And in our opinion, that's why having a more flexible investment mandate to go where the opportunity is, again, not to stretch for yield, but things that we believe add really strong risk management into the portfolio while trying to generate a respectable level of return.
And why do investment opportunities in bonds remain attractive regardless of economic developments?
Yeah, I think based on the strategy that we run, and again, we've talked about a couple of the things that we do, but specifically within the high yield market, high yield issuers are serial issuers. So they're always out there, they're levered credits, they're always out there refinancing their debt. So a big part of what we play might be a company that's going to pay down their debt in a short period of time, right? Or there might be something where there's an event-driven debt. These happen throughout the period of markets, no matter what the macro events that are occurring, right? And again, we've said this previously, but we want to focus on those individual credits in the business models. So whether it's event-driven debt or something where a company is selling a business line to pay off their debt, we want to get to that day of reckoning at the end that will allow us to get paid off at maturity.
You already spoke about opportunities in the Nordics. So Crossing Bridge manages $3.1 billion. Where do you see yourself in 5 years, and what role does the German market play in your plans? Because you want to grow, you are now in a partnership with Universal Investment. So what's your plan?
Yep, so prior to this point, everything that we've done has really been focused in the US, and we've been very fortunate of the growth that we've had. And I think what has resonated with investors is we've been in a very uncertain environment, and really the focus on not trying to maximize returns, but really emphasizing downside risk management over maximizing returns is something that has resonated with the market in the US, and from what we're hearing, really resonates with the German market as well. 5 years, way too far out there, but we hope that the growth and the partnership, we have a great partnership with Universal so far, and we're really looking forward to the growth and the opportunities here in Germany as well.
So thank you, Mr. Connor, Mr. Whitney, that you take us some insights to your work and what's your plans in Germany. Und auch Ihnen vielen Dank, meine Damen und Herren, dass Sie uns hier zugeschaut haben, direkt vom 33. Private Banking Kongress.
Great. Thanks for having us.
Thank you.
Yeah.